GETCRACK. Wake up, motherfucker.
We're going to hear from McDonald's. Now, listen to this. We're probably going to get a full airing of the E. coli situation, which has taken a turn for the worse. CDC saying the outbreak has grown. There are 26 new cases. It's too soon to tell how much damage is being done to the brand of McDonald's. Now, look, I think there'll be a short-term overhang. But remember, McDonald's has been on fire ever since they announced that $5 meal deal when a lot of customers really got more excited. Wall Street can't stay away from the stock. We'll know whether there's going to be a moth to the flame situation or whether it's just going to be solid for the rest of the year. The cruise stocks have become, they've probably been the strongest, most reliable names in the entire consumer space. Royal Caribbean is the number one. Operating a large beat and raise when they report on Tuesday. They keep doing that. By the way, I also think that both Reddit and PayPal will do terrifically. All three are hot stocks. I bet all three will remain that way. After the close, the playoff attitude shrouds the reports. It's tense. You need to be ready for the ecstasy of a clean beat. Or, I'll tell you, it might be the agony of a forecast cut. We're starting to see a few of those this week. First, we have from Alphabet. Now, the stock's been all over the map, but rarely in a good way. Now, we've trimmed our position in what you know as Google for the Travel Trust because it's hard to trust. Too often, Alphabet fails to impress. I think it's a great company, okay, but it's not a great stock because management often seems indifferent to the things that investors and analysts want to hear. They really need to talk also about breaking out Waymo somehow. They've lost a ton of money, and they don't have enough cars. Not enough cars on the road. And that has to change in order for them to show that they are not niche, which is pretty much how Elon Musk described them in his Tesla conference call. Hey, you want some controversy? Just say you like AMD, as we do for the Travel Trust. We know that AI is big enough for more than just one chip maker. AMD won't catch NVIDIA, but it will do enough to take chunks of the business. Plus, it has tremendous PC exposure right into the teeth of a big PC refresh cycle. We're buying more AMD into any weakness for the trust because this is a long-term terrific story. Chipotle reports, too. Without Brian Nichols, who's moved in to try to fix Starbucks, I think Chipotle will be fine. I don't know if it can break out from the 50s. The stock feels trapped, doesn't it? But the announcement of a permanent CEO could work some wonders here.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Results over in Japan. Markets continuing to digest, obviously, what took place over the weekend. Let's bring in Sherry on, our Asia Trade co-anchor, joining us outside Parliament in Tokyo. Sherry, what happened and what now?
It's really interesting to see how Japanese stocks are rebounding and reversing those earlier losses at the moment. How much of this loss for the ruling coalition was already priced in, right? Polls were showing that the ruling coalition would lose its majority. That's what happened. We're talking about the Liberal Democratic Party and its partner Komeito falling short of that 233 seats that they needed in parliament. And that, of course, will make a big difference on whether or not Prime Minister Shigeru Ishiba can actually hold on to his job when there is a parliamentary vote. And we've heard from him already talking about really public anger over what he called the funds issue. Remember, there's a lot of resentment here among the Japanese public, given how party members were enriching themselves secretly through funds provided by supporters. So that made a big difference on really how the public voted. And right now, the key for the Prime Minister will be trying to form a government. Many different scenarios that could happen at this point. Will he be ruling with a minority government and really compromising on issue by issue basis with other smaller parties? Will he form a coalition with smaller parties, or will he need to resign if he can't form a government? Are key issues which, of course, David Yvonne, will have implications for the markets.
Yeah, it goes to show, right? Changing the face of a party or a coalition doesn't really, I guess, fade some of those worries that they had around this scandal around this LDP party. Now, what is the future of Ishiba now? Can you tell us a bit more? Is his job on the line?
That is the key point, right? Because Prime Minister Ishiba really took the presidency of the Liberal Democratic Party with campaign pledges about cleaning the party. Since he was elected as president over the past month, he's sort of wavered on key issues. For example, BOJ policy normalization policies coming into his premiership, we thought that he was going to be vocal about the BOJ hiking rates, but then we saw him retreat a little bit, and that's caused a lot of market volatility and instability. What happens to him right now is anybody's guess, especially as we're headed towards a press conference this afternoon in Tokyo. We'll hear from the Prime Minister himself about what he plans to do.
Beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm.
Doesn't make sense. You don't solve anything with tariffs between us. Doesn't make sense because it's the same economy, practically.
I know you have some tariffs on steel, for example, from China at this point. How do you see the role of tariffs? When do they make sense? When do they not make sense?
Well, it's easy to abuse about tariffs, to put tariffs for any kind of article at the same time. We are not especially friendly with the tariffs for several fields because it can be costly for our economy, even for the United States economy. So we need to have a common policy with US. Let's see what happens in the next election, no? In order to have a conversation about the competition with China. Let's do something really effective, because you are not going to solve competitiveness through tariffs. Doesn't work.
The market tracks economic indicators daily to assess future trends. Some data is released quarterly, monthly, or weekly, but 3 lesser-known indicators may offer a glimpse into the economy's present condition. Number 1 is the first date indicator. During prosperous periods, people tend to meet potential partners through in-person activities. However, during downturns, dating apps often see higher engagement as people seek less expensive ways to meet others and support during stressful times. Number 2 references cardboard boxes. The more cardboard boxes being produced, the better the economy typically performs. The demand for cardboard boxes often correlates with economic booms and busts because it strongly represents the level of consumer spending. And number 3 is the Buttered Popcorn Index. This index suggests that when people are going through financial hardship, they tend to escape to the world of fiction, leading to an increase in the success of the film industry, regardless of the quality of films being put out. At the end of the day, these somewhat unorthodox measures of the economy actually make sense because most of them are consumer discretionary goods. People tend to only spend money on non-essential items or experiences if they have the extra cash or if they are confident they will have the extra cash in the future.
What's up, people? What's up? So the only news early this morning was all the oil and natural gas crashing from Iran's tepid response. Iran basically throwing in the towel and saying they're not going to touch Israel anymore as long as they meet some certain demands. So I guess we're safe. We're safe for now. And this gives another good buying opportunity. Oh, yes, because we have some oil earnings this week. And if you're a trader, if you want to gamble, perhaps as a short-term trade, you would be long some Chevron or ExxonMobil or British Petroleum or COP. So let's see. So I usually use Oil U. I bought some this morning. So I'll use it to trade again. As far as a long-term prospect for this sector, I believe we probably could, let me zoom this, make it full screen. We probably could see something starting in the spring, but I wouldn't expect anything to do much. It might pop into, the usual winter holiday season travel type bump, but it won't be permanent. So same thing with natural gas. It's like, yeah, like I said, if it can get through November, okay, it's going to be set up for the spring again. So for long-term trading, if you think natural gas is on its way up in a structural manner, in a secular manner, it will start in the spring, because I think based on the way it's been acting, no, it's not happening this winter. It's going to probably the winter forecasts have been mild. So the US, I believe what organization does the forecast for winters? Yeah, they said it was mild. It's going to be mostly rain, not too much of the cold snap that you'll see and it's mostly affected by the Northeast. So that's where all the population centers are. So if you want to see natural gas stay elevated, you got to see some storms coming into the Northeast. Otherwise, no. We're going sideways or going back down at this point. But yeah, you might see a pop on elections. It might go all the way up to here. So it might be a good trade as well, because Boyle hit 8 again. So yeah, you might as well just keep buying it when it hits 8. Like when it rips, just sell into it, keep some. If it goes back down, buy it back again, keep some. And that's all you can do, because yeah, it failed. It failed to break through in October. Once you see that, it's like, sorry, you got to wait till spring for natural gas to do anything. And with US oil, same way. WTI oil here back to about 67 a barrel. And we're going to have to look at Brent. So Brent is 71 a barrel. So yeah, it's down hard on that news, and that's probably the right time to buy, because this is probably the last low. And I'm not saying that it's going to just jump back to $100 a barrel, but from here it's just going to go sideways into next spring, and then from there we'll go up. But for a quick trade for earnings, yes, we have Chevron, we have British Petroleum tomorrow, ConocoPhillips, COP on Wednesday, and Chevron and ExxonMobil on Friday morning. So yeah, you have all those earnings. So if you think most of them will be positive, then from here on to Friday, yeah, you can buy some. No problem. But the problem with Friday is we'll have jobs report. So maybe, if you hold it all the way through Friday, you might get screwed over, because if the jobs report comes in too strong and the market starts shaking and quaking, thinking like the Fed will keep higher interest rates and not cut anymore, then yeah, that could cause an effect. Yeah, again, Friday will be a big deal, not only for that, but tech. So tech will be a big decider as well, because we'll have Apple, Amazon, and Intel reporting Thursday after the close. So that will affect the Friday morning again. So pre-market Friday, big deal. I have no idea what's going to happen. But I'm pretty bullish for this week at least. And if we're lucky, Friday goes well, it'll pump even further into elections. That's when I would start thinking of getting out or hedging, because then we'll drop into mid-November. And then from mid-November into Thanksgiving, then you'll buy again. So keep your eyes out. Keep your eyes out for opportunities, because Bitcoin is one of those big opportunities. So like I said, it will hit probably 72 again in Halloween. I have some positions in Mara, because I bought them at the bottom of this area here when it was like below 14.5. So this is a Bitcoin miner, MARA, and CLSK. Same thing. It was close to the 7.8 area. So whatever, I'll buy some here. Now I'm looking to add. So you can probably sell some. If you traded it, you can sell some here and then wait until after elections and then decide if you want to add more when it hits 15 for CLSK, and then Mara, if it hits maybe, well, yeah, Mars has a wider range. I don't know. Maybe if it gets past 22-ish, I would look to add again. So if you did a quick trade here, but you want to go for a longer position for when Bitcoin finally goes up, then yeah. So let me play this Bitcoin video here, so you can see what might happen to Bitcoin.
look at the volume come off of this LPS, I think really shows the presence of demand. And you can also see some higher volume in mid-September. And that's exactly what you would expect to see at the conclusion of accumulation.
I'm thinking, Bruce, we do some kind of structure like this before we go up.
Yeah, and maybe it pulls back into a second LPS or a third, or it does a backup. And if it starts to show the characteristics of a backup, where it's up here in this massive resistance zone of the old highs, that I think is extremely constructive.
All right, so that looks good. That looks good. That's what I want to see. So let's see where we are. See, I like that. I like this this structure that's being built right now, which is confirming it. So once we get to 72, we'll test it again and probably have another pullback, and then we'll have a higher one that stays above 68,000. And once we stay above 68,000, we're ready to move into first quarter next year, and that's when all the things will pump. Now, I have watched a recent video by the Foundation of Studies of Cycles this morning, and I would say be cautious. Still be cautious. The only way I would see those Bitcoin miners move up alongside Bitcoin is I see the small cap, like tech growth names, go up alongside Bitcoin. And this is really hard to say because it's very confusing right now. We're getting a lot of mixed signals. I really don't know what will happen until we get confirmation from Powell 2 days after the elections, and then who's going to win the election, and then what they're going to chit chat after. Like they're going to have some rhetoric to promote into January. So, they're not going to be in position until January, but they're going to talk a lot. So they'll control what we'll see in the markets. So here's the XBI right now. So this is one of the most sensitive sectors to interest rates in the growth sector. Okay. Small cap growth. And you see it's still stuck in here. So, I mean, we won't know. And then when you look at the IWM, which is total small caps, it's up, but it's only because, we have banking, regional banking up right now. So the KRE. So the most sensitive to interest rates on the value side is KRE ETF, which is regional banking, the small banks. And then you have XBI on the other side of the coin, which is growth. So the small cap growth. Now, if interest rates really are dropping for the right reasons, meaning they're dropping only because the Fed is okay with inflation trends right now, and the economy is not shrinking and collapsing, then good. We're all good. So we have to look at the TLT, the bonds, and we're still stuck at this bottom of this range. I don't want to see it drop into here. You don't want to see that. TLT is at 91, so that's equivalent to a 30 bond yield of 4.529% right now. If you see this going up, that's not good. It's going to start eating into home sales and all the other stuff. Right now, ITB is having trouble, as you can see. So this is home construction ETF, ITB. So it's the one that leads everything. So ITB was actually going up while interest rates were still moving higher because people were thinking, I can compare it with this. As you can see, like the long bonds were still going down, but ITB was bottoming, signaling that the market already knew that we were hitting a peak point in bonds. So that's where we're at right now. We have to see how it goes. So a lot of these interest rate sensitive sectors, we have to examine pretty carefully. Now, you saw the last video, we were talking about a discretionary over staples. So let's look at the indicator right here. So if you look at popcorn or dating apps or whatever, essentially they are discretionary stocks. So right here, this ratio has been moving up, and probably mostly thanks to Tesla. So I think that's kind of an outlier when you see Tesla move up. So we got to see how it goes into this week when we have Google and all the other ones move on earnings. So I think afternoon we'll have Ford earnings, and then tomorrow we'll have Google, AMD. We have Reddit too. Reddit. That might be an interesting earnings stock if you'd like to gamble, because Reddit has been doing quite well since IPO in March 2024. So if you see a lot of people using Reddit, that's probably also another interesting sign of the economy. Yeah. Yep. So let me see what else we got. Yeah, transportation. So yeah, I'm gonna go over some of the earnings that was happening last week that I didn't get a chance to cover. Okay. And I'm gonna go over some stocks that Blacks mentioned, Blacks Who Defy, and he was looking at these nuclear stocks, which quite interesting. I was paying attention to them. So Friday we had LTBR was going up for some unknown reason, and now we have a real news that happened on Monday. So somebody knew what was going on, but this is very volatile stock. Like you can see, like it's going up like 30% in one sitting, 157, 35. Like, oh yeah. This is not if you're an investor, well, you better like this kind of volatility. Yeah. So these are micro cap stocks, nuclear stocks. The only one that I recognized that he mentioned was LEU, and it will have earnings after the close today. So yeah, I will be looking at these three stocks this week, see how it goes, because right now mining stocks have taken a break. They have taken a break, but these three are actually infrastructure. So again, you remember we were talking about like going through the supply chain or going through the value chain of a business or industry, and you'll see many layers, right? So you could have a retail auto parts and they're making big money, but then you have the distributor of those auto parts like not doing well because they're inflation. They can't get around inflation, right? But the retailers, they can charge the customer and make up their margin and still go up. And so, yeah, this is why business is so hard. You know, I rather not be in business because I don't want to deal with the issues. But when you're doing stock market, you can move around, right? You can go to the mining of uranium and they have a cycle where they go up and then they take a break. And then you go into the infrastructure of uranium where they're dealing with utilities. And then later utilities will go up. The utility companies at the end to the consumer will go up because then they can overcharge the consumer and get their money back. So that's why you go through the cycles of business. You can fine tune it where you pick the stocks across all cycles where you say, okay, the miners go up, then the infrastructure, then the actual end utility that goes to the electricity that charges you money. So there you go. There you go. What you take? Okay. Penny stocks, that's up to you. That's a personal matter. Like I don't need to play penny stocks, and these are technically penny stocks because of the way they behave. Like here, you want a penny stock? Like I could do this one, right? Mine med, like, or you could do like some other drug companies. Like these are crazy ones. See, perfect. This one hit. So this one's mushroom LSD. Like they got FDA approval around March. That's why they pumped. And then now they pulled back. And then now we're in this gap area here. You see this huge gap? Like, all right. So this is an important area. It's like going through it is important. Going into it is important. So it's trying to hold it. So we got earnings coming up November 7th. Is it a buy? You want to buy this penny stock? I don't know. Yeah, maybe this is a good entry, but penny stocks, yeah, it's a hit or miss. It's a gamble. I personally wouldn't do it. with big amounts of money. Like, it's a personal thing. If you have very little capital, I would probably suggest it's better you learn options trading and try to gamble your way up. If you have a lot of money, you can set a small percentage on penny stocks like this, because you never know. Some of them will be winners in the long term. But as trades, they're fine, but you have to like monitor them very well. Like here, you see this? You made a low here. You made a higher low here. You could have traded this, get out, because you see this area. You see that? You see that bottom here? That was a significant bottom. So you would say, like, here, I would trade down here, get up close to here, sell, go back down here, buy. Like, I mean, yeah, you could do that with a penny stock, no problem. But yeah, if you're not into trading, like, yeah, I wouldn't be into it too much. If you're into long-term holds, penny stocks are kind of going to be something that you'll have to make a personal decision on, like how much money you're gonna allocate into it. I guess this silver miner is a penny stock too. Like here, I've been playing this one. This was the one I recommended. Like, I didn't get it down here at the absolute low 1.4, but I definitely, like, once I saw silver like try to go through the summer okay, then the next time it dipped right here, 2.5, perfect, because it hit this red area. Then I added more here, like when it went to 3, went through 3, right? I was like, okay, it cleared here, buy more. Once it cleared here, and I said, like, all right, it's not dropping back, I'll buy more. Once it hit here, then I just started selling. Okay, because this area, yeah, is really important for not only this, but also when you look at silver and all the other ones. Yeah, silver. Yeah, because once you get across this area, this whole range, like let me get the futures chart, for silver. Was it this thing? No, I probably put it in here. Oh man, Bitcoin's still going up. That's good. Yeah, right here, 34.4 an ounce. This area, like if I just zoom out, this was set way back when, this resistance, probably February 2012, September 2012. This was a high in this area. So yeah, once you hit here, you're like, this is a good time to take profit. Doesn't mean it can't just keep going up. It's just like, well, I'm done with most of my trade. And if I'm doing long term, I'll keep some, but it's nice to take some profit, because here from 2.5 to 5, that's 100%. Why not? I'll just take some profit and leave the rest for long term if I feel like it. So that's what it is. That's how you should think of it. So there's another one, TMC. TMC is a underwater, under the sea mining company. It does nickel and other like metals. I mean, it might go up one day. Like, I like it. Every time it drops below $1, you kind of see where it is, and you might as well just buy, because when it pumps to 2, you can sell again and then keep some just in case it'll go up. And you keep doing it. So you keep doing this until eventually it gets sick of this range and break out, right? But yeah, you can just buy some, then sell a bit, just in case it'll keep going up. But if it can't, it'll go back down. You buy again, buy some. So that's kind of like you're kind of halfway doing trading and investing at once. You know what I'm saying? So it's a personal thing. It's really a personal matter. And a lot of stocks, when it's very volatile, and a penny stock, which is even more volatile, like this, like here we go, Zim also very volatile. Yeah, I'm in it. Let's see what happens. Let's see if it breaks. It might not. It might just go back down again. But I was buying here at 18 because I saw this range. And we can look at HIMS, like that Ozempic generic maker. See, you kind of like have to look at it and say, well, we're right back here at the top of this. Yeah, see, so this line that was drawn way back when, 24. Yeah, you could see it. We see the whole resistance. We're waiting. And that's why when I look back at the ETF, so I'll remind you, the ETF here, This is important. We got to see the whole group move up, because even though HIMS is outperforming that group, the only way it will really have we will really have confidence that it will break that resistance is if the whole ocean level rises. Okay, you can think of it like the tide lifts all boats type thing. So when the whole sector moves up, you look for the strongest of that sector. So that's why when we're doing the scanning, that was it. That was it. Yeah, it was just a day trade. Yeah, see, there you go. All he cared about was the volatility. That's right. So that's what he's looking for. Like, but if you did penny stocks and you wanted to have massive gains on a small account, like let's say you have an IRA account and it's really tiny because you didn't go to work and go through different companies where you could roll over a lot of 401ks into your IRAs. So if your IRA account is very tiny, then holding long-term penny stocks makes a lot of sense. If you like that's why I kind of say, okay, you have, let's say you pick 10 penny stocks and you just dump $1,000 in each one, right? Because your account is only at 10,000. Like a lot of people have very tiny IRAs because they're not working. Like, I went to work and I got 6 figures, all right, and I could roll over tons of them. But a lot of people don't have that situation. They're just like personally making their own IRAs, and they're waiting until like they retire to roll over their 401ks into the IRA. So then they have very small IRAs. Then yeah, you probably could do it this way, where you just try to select as many potential penny stocks that look good to go up, and you would try to grow your IRA account, because then you could build a huge tax deferred account by the time you retire, and when you cash out, it's good. So that makes a lot of sense to do it that way. And I think some of them allow you to do options too. So you could probably buy leaps on some of these ridiculous. Well, yeah, some of these penny stocks probably don't have good leap options, but never know. I'm not a big expert on that, on the whole options market. So you probably should look around. But yeah, you could do that, and you don't need penny stocks to be penny stock action, to get penny stock action like here. So this is the Bitcoin miners. It was up 34% 2 weeks ago. So I am holding and waiting to see what Bitcoin does in the next couple of weeks. And once you get that, boom, you got out. Yeah. So you can sell some, take some profit because you're at the top of this range, right? Because you see this huge candle here, 68% back in February. So this is a significant bar, which aligns with these 3 red candles on the weekly chart. And that's why I drew this dashed line. And so we're near the top of that dashed line. And that's probably where you would sell some if you're a trader. If you're an investor, yeah, you'll keep holding and wait to add when it breaks out. When you get the confirmation, then you'll add. So yeah, it depends. And you could do both, right? You could buy a ton here, sell some when it gets to your interim target, keep the rest for when it gets to your next target, sell some more, wait for confirmation. And if you think it's finally getting ready to break out of this range, you just buy everything back again and go up. So you could do it like that, very conservatively. If you're like me, you just have capital to push in and push out periodically like that. So, and you have to actively manage it a bit. So that's really the problem. A lot of people won't have the time to look at things, and this is why you got to have really good techniques where so you can get more efficient. So you have a scanning where you're looking for stocks automatically for you, potential targets for you, and then you have a quick way of reading the charts where you just quickly go over. So whatever you have in the scan results, you'll be like, okay, quickly just look at the chart and decide, okay, look, I'll just zoom out, I'll just look for the big candles here, and I look for big patterns, and I'll decide, hey, this is where I'm at. Quickly make note of it, and then set an alert. Like you can set an alert, right? You could just go to like here, I could just set an alert, and it'll send me like go and send me an email or text message. And a lot of these services do that. And that's why you got to be, it's all about the process is more than anything. The process is one level of understanding. Looking at charts, understanding that is the first level, right? And doing your psychology where you are just treating it like a simple algorithm. You are not overthinking things and you are not using emotion. Everything is just basically look at the chart. All right, you see this, I see that, I see this. Done, 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 done. Boom, 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 boom. That's it. And that's all you got to do. Really, that's really it. Okay, let's see what else. So I got to go through some of the earnings. So that's what I wanted to do. Let's see if I can get through some of these. So we had some earnings to go through yesterday. So I had this one. Tractor Supply Company. So it had some nasty earnings, I guess. It dropped 8%. So now here we are on the weekly chart. Ooh, man, this might be the time to buy Tractor Supply Company. I don't know. I'm going to watch it. TSCO. Another one last week was a Nucor. So steel company dropped 10.6%. It's recovering this week. So it might be at a bottom. This might be a turn. So we're going to have to look at that. And let's see, GE, yes, also big volume drop here. So we'll see where this pulls back. GE might be a good long-term stock for people to add. If you guys missed it, you know, it was a nice turnaround story in 2022, 40 to 180. Oh, 190, actually. Okay. Yeah, so that might be something to look at. We have DLR, Digital Realty Trust. Very interesting because this stock is a sideways stock. It's a REIT, a real estate investment trust, but it specializes in data centers. So it had a surprise pump last week. So, hey, if data centers are going up, I got to be very bullish on the upcoming earnings for Google, Microsoft, and you know, all the other ones, Amazon, Apple, blah blah blah, Meta, Facebook, you know. Also another crappy stock, Western Digital, usually very crappy because it's quite cyclical. I told you guys about cyclicality. You see this? It goes up and down, up and down, up and down. You can kind of see a wave, right? Up, down, up, down, up, down, up, down. Even despite COVID, it doesn't really matter. I mean, you could say it's like it's still down, up, down. So it has a pattern here. It has a cycle. But when you see this, where it is going up on news of AI and all that other stuff, I like it because then you get a secular story. Once you get a secular story and you see it on these weaker stocks, then you got to say NVIDIA probably is ready to pump into next year. But I'll give you a question mark. Do not believe that it will, though. There's no guarantees in this business. So even though we think it will do it, just because of what we see on other stocks, doesn't mean it will. All right. That's a problem. And let's see what else. What other ones? Oh, yeah. Trucking company, SAIA. Very good earnings. Yeah, I think, I don't know, like, how's the index doing? The index is doing fine. So this is a transportation index. It's still at the top. Not really a confirmed breakout. And this is a top set in May 2021. This is a very important area. You see that? If the economy really is doing well, you'll still see a breakout. Once you see a breakout, it's done. That means you can't say the economy is shit. So there you go. Yeah. Triple M, MMM. Yeah, 3M. Not bad looking chart here on the weekly. It's pulled back on earnings. It's got an upgrade today, so that's why it's pumping. Yeah, it looks all right to me. This might be something to get. if you're doing a long term. Another one that was reported today is Mexican cement, CEMEX. CX is the ticker. So this is what I've been eyeing, and it dropped. Does it mean it will go further down? I am not so sure. It could, but that's related to what I played earlier about the tariffs and all that with Mexico and Donald Trump. I'm not sure what's going to happen there. But here, this is the ETF for Mexico, EWWEU. As you can see, it's right around this area. So whatever resistance and support was made in 2022, November, and then again, October 2023, it's tested it twice after the election. So elections, all the Mexican stocks dropped, and now we're testing it again. So I'm eyeing this. I think it is a good time to buy Mexico just because of nearshoring and anti-China sentiment. So let's say at the top of the December 2019, just before COVID. So if we see Mexican stocks drop and this ETF goes into 48 area, yeah, I'd probably buy. And if you're really a gambler, you can buy the ETF MEXX. This is 3 times the daily motion of EU. So you better time it correctly, though. I wouldn't buy it here because you might get blown out of the water if you time it incorrectly. Yeah. Yeah, that's not fun. But anyway, you see this list I got, SPPPP, SRUUF, like, so these are the Sprott ETFs for copper miners, nickel miners, lithium miners. Lithium doing quite well. Actually, I have 2 more stocks to talk about earnings. RTX Raytheon, yeah, it had a dip, but not much of one. So it popped, it dipped back, nothing really. I think it's kept its trend. And Lockheed Martin was the one that got a little damaged here. So I'm not sure what you want to do with this right now. Yeah, it doesn't look like it's a buy yet. I think that's too much damage to say it's a buy right now. I think you're gonna have to wait a bit. But I mean, if you look at the long-term chart, it's still holding trend, right? But if you're afraid that it'll drop back here to 490, yeah, okay. I don't know. That really depends. Because I mean, for me, yeah, it's all about Palantir. I think Palantir is going to report soon, so that's a bit of a trouble. Yeah, Monday, right? So yeah, if you don't want to keep some of your shares of Palantir, it's probably a good time to start thinking about selling when the Nasdaq goes up. Because if the Nasdaq pumps a little bit more, yeah, you probably want to sell a bit or hedge. Yeah, you can hedge some, right? Sell some calls or buy some puts on whatever shares you're holding right here. Yeah, before the Monday after the close. And it's near elections, so it makes sense for you to put insurance on it. So lithium, LAC is still the one that's going up. This is Lithium Americas Corporation. Okay. So I like this shape going on. We are hitting some level of resistance, but still very volatile. Another favorite of mine is SGML. So this Brazilian lithium, Sigma Lithium Corporation. We got that. And a PLL. Another nice one. So yeah, it will have earnings soon, actually. Friday. Maybe Friday? November 1st? I don't know. I don't know if it's confirmed. But yeah, you see this pattern where it goes undercuts, makes a high to test this area here. Yeah, that's good. So it's nearly testing this area. It's making a cup shape. Yeah. Fuck. I mean, if you don't care about the volatility, because this is very volatile, right? It's going up 20% to 30% a week, and it could drop the same amount like during this week. Shit. Yeah, okay. You might think about it because it's turning around. It's making a turnaround. It's trying to do it. And the same thing with uranium. So a lot of these uranium stocks I'll have to keep paying attention to. Uranium miners, I think, are done. But let's look at the LEU, the infrastructure ones, NNE, and LTBR. Yeah, these are some crazy looking stocks, not for the wary. So we'll see how that goes. Okay. Let's see what's in the video. So I'm going to play this video of Hearst cycles. So it might be too esoteric, but maybe some of you guys might find it interesting.
Market update. I'm going to be providing you with a glimpse of the future, not only because we are going to be taking a look at the future line of demarcation cycle tool, but also because I'm going to be giving you a glimpse of our new sentient FLD trading view indicator, which has been in development for many months and is now approaching the end of its beta testing phase. It has passed the beta tests with flying colors, and we will be launching the indicator upon an unsuspecting public within the next 2 or 3 weeks. And so in today's market update, I'm going to be providing you with a glimpse of what that indicator does on TradingView. Here it is. We're going to be taking a look at a little bit of the detail, and I will also provide a link in the description below this video so that you can join our early notification list to be notified as soon as the indicator is available. But let's take a look first of all at Sentient Trader so that we can update the analysis that we have been tracking in the S&P 500. This is SPX data. My previous market update video was recorded 2 weeks ago, which was on this bar over here on the 14th of October. In that market update, I discussed various reasons why I considered it likely that the 80-day cycle trough was coming in early. And you can see that according to this analysis, that 80-day cycle trough has been found to have occurred over here on the 8th of October. What that means is that we were expecting a 20-day cycle trough to form sometime last week. And indeed, it seems that that 20-day cycle trough has formed. You will notice that I am not only displaying the 20-day cycle FLD on this chart, but also 2 VTLs, because we had a very interesting question that was asked, I think it was on our Discord channel, about the crossing of the 40-day VTL. Let's zoom in and take a closer look. Here you can see these VTLs, although of course they're only plotted as short extensions of the lines. Why is price crossing down identified by the indicator in TradingView? Notice, as a matter of interest, that it occurs a few days earlier than the 80-day cycle.
All right, I'm going to skip around a bit. So I think here,
our 40-day cycle trough expected over here in the second week of November. Measuring the number of bars up to this 80-day cycle trough, I can repeat the slight dilemma that we faced in the previous market update in terms of whether this 80-day cycle trough is an early 80-day trough at 64 days. There is also the possibility that the 80-day cycle trough would be better phased over here as a late 80-day cycle trough at 79 days. And looking at the same instrument on TradingView, you can see that the Sentient FLD indicator has chosen that alternate analysis, the alternate placement for the 80-day cycle trough over here in the analysis that it has performed. Notice the power of these FLD targets. Here is a 40-day cycle target, which was positioned at this level over here, just ever so slightly below the formation of this probable 40-day cycle trough. The targets on the TradingView platform include time and price level, and so this is the exact time that that 40-day cycle trough was expected, and at this level over here. Of course, the 40-day cycle trough probably occurred about a week before that, at almost exactly the same level. Notice this 40-day cycle target to the upside, which has not yet quite been reached. You can see that price is approaching it, but it hasn't reached it yet. But notice also the timing of that target. Let me clear those pen marks. That target was expected exactly over here, and over here we did indeed experience a peak in the price action. Zooming in on our TradingView chart, you can see that the 20-day cycle FLD has upward pointing green triangles indicating that this FLD is expected to provide support at this point. You can see that price has already crossed the FLD to the upside, and that is why we are expecting support at the level of the 20-day FLD. Notice this target from a longer time frame. We have an 80-day cycle target from the weekly time frame up at this level over here, which is going to be interesting to watch. Looking at the Australian stock market the 80-day cycle trough has been identified at this trough in the first week of October. And zooming in, we can see that the indicator has identified this as a D category interaction, and we are expecting next an E category interaction. There are our green triangles. 80-day cycle trough, which potentially could have formed at this point over here. But I also pointed out that the important level to watch would be the 20-day cycle FLD, because we would need price to cross above the 20-day cycle FLD to confirm that that trough had formed. Notice what happened over here. Price significantly failed to cross above the 20-day FLD. In fact, it found resistance at that level, thereby failing to confirm that the 80-day cycle trough had formed and making it much more likely that the 80-day cycle trough lay ahead of us. Here is the nest of lows for that 80-day cycle trough, and we are looking at that 80-day cycle trough forming about now. Again, confirmation would be required by price crossing above the 20-day FLD. Notice the identification of the interactions between price and the FLD, and here we have a much more usual GH category interaction pair. Looking at gold, there isn't very much to say. The 40-day cycle trough that we were discussing in the previous market update video, which I recorded over here on the 14th of October, has been confirmed and found in the phasing analysis. Price has risen up to a new and higher peak, which was exactly what we were expecting. In gold too, we are looking at a trough forming in early November. You can see that it is marked as a 20-week cycle magnitude. We have a very extended 20-week cycle circle and whiskers. Why is that? It is because the 20-week cycle has not been as regular as the other cycles have been in recent analysis, and that causes that very stretched out circle and whiskers. We can simply hide that, of course, and rather focus on only the 80-day cycle and shorter, which would be my preference. The important thing, of course, is that we are expecting a peak to form in gold. It might lie slightly ahead of us, and then price is expected to cross down below the 20-day cycle FLD on its way down into this trough in November. Finally, Bitcoin provides us with an interesting situation. Let me actually turn off the composite model line, which is not providing very much extra detail at the moment. This is the analysis we've been looking at in Bitcoin for some time, with an 80-day cycle trough over here in early September. If we zoom back a little bit in time, you will see that the reason that this is an 80-day cycle trough is because of the fact that I have influenced this analysis and positioned the 18-month cycle trough over here in early July. I discussed the positioning of this 18-month cycle trough in market update videos pretty much throughout July and in early August, so I won't repeat that argument now. It is still, in my opinion, a viable position for that 18-month cycle trough, but many analysts would prefer to position that 18-month cycle trough over here in early August, which would of course match the 40-week cycle trough that formed in the many stock markets that we have been looking at. Notice that if this 18-month cycle trough would be better phased in August, that would simply shift all of these diamonds over by one 40-day cycle. What that would mean, of course, is that this 80-day cycle trough should also be moved over by one 40-day cycle, making this an 80-day cycle trough over here. The reason that I bring this up is because the recent price action over just the past few days raises the possibility that in fact the 80-day cycle trough is better phased in early October. Considering the price action that has occurred since early September, where currently we have an 80-day cycle trough marked, you can see there is nothing that really jumps out, making this analysis incorrect. We have a clear 40-day cycle trough over here on about the 10th of October. But if we identify our price interactions with the 20-day FLD, you will see a good clean sequence, A, B, C, D, E, all the way up to this F category interaction over here. Notice this red circle drawn around the F category interaction, indicating that that interaction is still ongoing. And that is not what we expect from an F category interaction, where price should cross down below the FLD on its way down into this trough that we are expecting, as in all the other markets, in about the middle of November. And that provides us...
So you hear that? So most of the analysis that you've seen so far are things like, okay, mid-November we'll have a dip, which coincides with the election. So let's say we won't get our results right away for elections, then Jerome Powell does something stupid 2 days after, the markets just sell off right into Thanksgiving, then yeah, that would be what would happen. But let's see what he says here.
With an anomaly, because this is not what we expect when price crosses below the FLD in an F category interaction. So what could be happening here? Let's take a look at what the Sentient FLD indicator on TradingView has to tell us. Here is an analysis of Bitcoin against the US dollar on TradingView, and here we have our stack of diamonds for the 40-week cycle trough that has been positioned over here at the beginning of August. As I just mentioned, that is a very popular position for that 18-month cycle trough, although this is only phased as 40 weeks. Why is that? It is because the Sentient FLD indicator only in fact plots the information for 5 cycles on your chart to avoid excessive clutter, which is always a disadvantage when you are plotting the information from too many cycles. And so we have a 40-week cycle trough at least positioned over here in early August. Notice the 40-week cycle target from the weekly time frame, which was achieved so accurately on that day. But here is the interesting thing that the TradingView indicator shows us. We have our 80-day cycle trough over here, as mentioned when looking at the chart in Sentient Trader in early October. Notice again the accuracy of these targets. There is the 40-day cycle target, which was at exactly that 80-day cycle trough. Zooming in for a bit more detail, we can see our A category interaction over here, which generated a target at that level, which was easily achieved. We also had an 80-day cycle target achieved over here, and various longer time frame targets. Notice we have a 40-day cycle target, which is at this level over here, indicating the possibility that price must still rise up and achieve that target. Notice, however, the timing of that target, which was over here, where we did indeed experience a peak of sorts in the price action. But very importantly, look at the interaction between price and the 20-day FLD. You can see that we are now expecting a BC category interaction pair, and those green upward pointing triangles indicate that the 20-day cycle FLD is expected to provide support to price at the moment. Here is the nest of lows for the 20-day cycle trough, and here is the same nest of lows for our 40-day cycle trough, expected, of course, in about the middle of November. Notice this interesting target generated by the monthly chart for a 20-week cycle target. It's a fairly high target, certainly something to keep an eye on. I do hope that you have found this.
Well, I mean, in any case, I think we will hit 72,000. But after that, I don't know. So let's I just finished downloading this video, so I wasn't expecting to do this, but hey, let's go into it. I think it's very important right now for you guys to listen to this one.
This episode
into the making for
visual.
In the US, you're still on summertime, so excuse the time zone offset we have. I think this will resolve during the next weeks. And today, we must talk about the US tech sector, because there's an important cycle to talk about. And this is what I will put into the making for today. And besides that, let's try to make this the shortest cycle analysis episode of all time. Okay? So let's try to do that, and let's get it going.
But I can't forget the words my baby said. She said, what goes up, I know one day it's got to come down. Then she said, what goes around sure comes around.
Yeah, what goes up must come down. So what about the US tech sector? I mean, it's just a question of time, right? And the question of time, that's the purpose of cycle analysis, what we're doing today. Let's get into that first, right? And to talk about that, I mean, here's the chart we've just seen. And I mean, for the short episode of today, that's it. So have a nice week, have a nice day. That's it for today. Everything else is on the chart, right? But okay, for sure, let's talk about that. What is that cycle about, what we're seeing here? This is the long-term Nasdaq Composite weekly, and the cycle we are currently seeing is the 177 weeks, also the nominal 180 week cycle. And it's currently in the topping situation. So now you might ask, why is the cycle of 180 weeks important? If you are following this channel and those cycles, you know about that 180 weeks is approximately 41 months. So we are talking about a 41-month cycle. So now you might ask, why is the 41-month cycle so important? Let's come to the point. This cycle has been detected by Dewey already in his research. The 41-month cycle is a prominent cycle in financial assets. So there's a long history that dates back the 41-month cycle. But I would like to keep this episode a little bit short, and therefore, if you want to learn more about the 41-month cycle, just head back to the video I've recorded here some months ago. You will find it in the description below that video. There was a lengthy talk about the 41-month cycle in the making, and I have made a lot of reference to the analysis from Dewey. So there's really more to come. In addition to that, and that's also interesting, I showed you that cycle, I think it was 7 months ago. I think it was in April this year. And from a timing point of view, we have been in the midpoint of that cycle. And in that video, I told you that there's still a long way to go, until we arrive at the possible topping point in time, which was projected on January next year, 7 months ago. So I made the call that we can have a very positive continuation in the US markets until end of the year. Please head back to that episode. It's all recorded. And we are now moving into the projected time window of that cycle. So this is not new. I was waiting to arrive at this point in time quite for the past 7 months. So we are here yet. We are here yet. So that's the long-term story on the 41-month cycle, which is currently topping, which gives us now the time window that the long-term cycle is rolling over. So the long-term uptrend from a time cycles perspective seems to roll over into a longer downward facing period. Yes, you have.
But I can't forget
correct.
The words my baby said. She said, what goes up, I know one day it's got to come down.
Yeah, so that's it for the timing, but there is a cycle behind. So now, as you know, let's move to the daily chart, right? So let's have a closer look on when the exact timing might be expected. Therefore, as always, we will jump to the daily chart. This is the daily Nasdaq Composite, which I'm showing here. And what we're seeing here is now the two most important, or at least 1 to 2 most important cycles on the daily chart. First, which cycles have been picked here? Let's zoom in. The first one is this 200 days cycle, 200 trading days cycle, not calendar days cycle, which is the main driver here. And then there's for sure this shorter term peak, which can be seen here with around 80 days. So there's also an 80-day cycle. So these two seem to have a very good rhythm here in the market. If we just see the rhythm of those turns in the market here, which looks quite nice. And we are approaching now the next two, and that's important now, the next two possible topping periods from that cycle. So and that's the key now, what we're seeing here, because in the past, those, or let's maybe just focus on this longer term daily cycle. So if you see the topping of that longer term daily cycle alone, so that's the most dominant daily cycle, what becomes obvious that it's pointing now to the same timing as the long-term cycle from the weekly, if you remember that. So we will here have a synchrony of cycles coming up at the end of this year, so around a month to go. And that's what we are really looking for. Synchrony of cycles in regards to time between the daily and the weekly. And let me tell you a little bit more on that and on the rhythm of that daily cycle in the past behavior, because we're here for cycle analysis. So the short-term version I just gave you in the introduction, I think now we are here to learn something. Cycles are about timing. So let's connect a little bit the periods, or let's have a closer look on the periods when those upswing phases occurred. Let me circle that in. So that have been the timing window from that, just the up leg of those daily cycles, right? This is just the up leg phasing from a timing perspective. And in this windows, we have seen the most important upswings here, right? In the downward phase here of those cycles, we have mainly seen sideways movement. And that's also a classic pattern which can be seen in the context of the longer upward pointing weekly cycle. You might remember that this period from 2023 now up into end of 2024 is the period of the long-term 41-month cycle. So if you see a downward facing cycle on a shorter time frame, which just results in a sideways move, or let's say pausing of the main trend, that's exactly what is expected from that cycle. So we cannot assume that this downward cycle on the shorter term period compared to the weekly might push the overall prices really down, because the weekly cycle is still pointing up. So we see these kind of upsloping stairs here. But the important point I want to make today, and that's really the window I have been waiting for now for about a year to come. The daily cycle rolls over to the downside in alignment with the weekly cycle rolling over. That's a key change in market rhythm to be expected here. And that's now the key on the short-term timing. So from a timing, there's short-term. There might be some days to go until end of the year, right? So maybe until December, maybe past the election, whatever. I mean, there's also, we have the earnings period, the election coming up in November. So there's quite a nervous period for the US anyhow during the next 2 to 3 weeks. But passing that, I don't see much more room to the upside talking about time-based cycles. And this long-term cycle really worked out quite well. So last but not least, finally, the reason I'm bringing that up now, I see two possible points in time. The first turning point occurs here early November. So early November is the first possible turning point when this could be resolved. The second possible turning point then arrives end of this year, early next year. So in fine-tuning the timing for the weekly 41-month cycle, we should look into early November or early January for the short-term turn to happen. Second, or last but not least, let's move now to the technical chart for a second, because this is what I'm mainly always proposing here. Once you have your cycle work done or your cycle analysis work done, so you have an idea about the timing, the dominant cycles you're monitoring, you must move over to the price action. We all can only trade price. No one is able to trade time. So if you want to transfer that into tradable action, you need to check the price chart. So in order to do that, here you see the Nasdaq Composite daily, and I've highlighted some interesting points. First, and let's not disrupt ourselves here too much. First, let's cross-check the cycles RSI. This is a standard RSI indicator. Just the length configuration has been adjusted to the dominant cycle length, which is a recommendation for every technical indicator. If you set the parameter for your technical indicator to an harmonic relation of your dominant cycle length, your technical indicator, which will become much more readable. The first interesting point here is that that indicator gave the major turn already here in July, which is quite interesting, marked by the red shaded background, which means that the weekly was in time, and the signal here crossing now below the upper band, which was quite a perfect signal at that point in time. But however, as we are now rolling forward into November, December, where we expect the next cyclic turn, we see here a divergence showing up. I mean, we need to see if maybe the Nasdaq can push above that. But right now, we have not really made an important higher high in the Nasdaq. I mean, we have in the S&P, but not in the US Tech, while the index here is making a lower top, yeah, on the index. And you know, this is a divergence pattern, which is also interesting, which forms up here, which just adds more indication about that the turn might be around the corner, or just with the jingle, what goes up needs to come down. And it's quite working into that time window here. Another indicator I like is about momentum. Yeah, momentum is always important to monitor, to judge a little bit the price action. So never trade against the momentum in the markets. This is a momentum indicator which is also tuned to the dominant cycle length. What I just want to highlight here, that we see that momentum is also forming a divergence against the price pattern. So price seems to move up here since the summer period, or has been moving up here since the summer period. However, the momentum has not been ramping up with that. So, and it's even in the negative zone. So we don't have positive momentum there yet, while price moved up against declining momentum. That's also not good technicals. So there are no good technicals around us in the markets right here. And as said, for the timing window, we have prime time. We have prime time for the topic I just said to you.
But I can't forget the words my baby said. She said, what goes up, I know one day it's got to come down. Then she said, what goes around sure comes around.
Yeah. So I think that's why I think it is important today to review the 41-month cycle here all together. All right, as I
Hey, so that gives you a little bearish potential on the tech sector. I think, you know, you got to take into advisement what I expect at this point is we will have at least this week going up on earnings. And if you're lucky, Friday will be a good confluence of data and earnings together. That will spill over into Monday before elections. So you'll have at least 1 to 2 days. But after that, I would be very cautious if you're long. But for now, I see good things, at least in the positions I'm holding. Yeah, you got Bitcoin miners. I'm liking that. I mean, if Donald Trump wins, I think Bitcoin may not have a pause. Maybe it'll just keep flying up. So today we have Mara up 11%. We have CLSK up 10.71%. And I added some of these tickers for you to look at. The trash Bitcoin miners. Wolf, Gwyneth Paltrow's favorite Bitcoin miner, WULF. BitF, BITF, BTBT, BTBT. I don't know what the heck was the name of this thing. Bit Digital. Like, there's so many of the garbage ones. And HUT, ooh, nice, 16.4% HUT. This is not something I would invest in, but it's definitely something I would trade in. Like, let's look at this chart of HUT. You got this nice range, excellent range, made using 2 lines formed in 2020 and then again in 2021. It's been hit multiple times on this upper side in August 2022, July 2023, January to December 2023 to January 2024, and then again this summer, July to August, it tried to pop up, fell back, and now we're at it again. $16, $17 a share. So when you make something like this, I gotta say, you're really gonna make something big. You're gonna make a big move. And we got a lot of these miners replicating themselves, doing the same thing. I don't know. It really depends. I mean, I could see, as I showed that video, where this goes up to 72,000 and then pulls back. We got about 5 minutes until the market closes. I don't think anything has happened, really. QQQ hasn't done anything. Whatever it made during the opening, it just lost. Nobody wants to do any major move before earnings. All right, we're not going to have major earnings starting until Tuesday afternoon. SPY, yeah, see, it's barely doing anything. We're not going to get any real movement. So everything now that's happening is nonsense. The only thing that has done something is oil, natural gas. So if you're bullish on oil, yes, you can start playing the companies. You can use the XOP ETF. OIH is another ETF. There's oil services ETF. But I just use the 3X ETF, oil U, OILU, which follows 3X 3 times XOP during the day. So yeah, you can trade that. That's about it. And if you want to do natural gas and you want to trade that, yes, you can buy Boyle back at 8. We hit 8. I don't know if it's really gonna try to go against 10 again before the election, or maybe it'll pop over 10 if Donald Trump wins. That could be a potential trade right there. Only thing is, yeah, small caps still doing okay, but not really sure. TLT bonds, yes, still holding on, and the Dixie. So looking at the dollar index, yeah, it wasn't really damaged from whatever happened in Japan with the election. So we're still okay, even with the uncertainty of what's going to happen in Japan. Now, let's go to some trading videos here. See if I can get through some of these. So this one I'm going to do real quick. So this is a seasonal trading. So this kind of matches with the cycles. So you might get something off of this.
Hello and welcome to.
So this is Alcoa. I think he's going to go over Alcoa and 3M. So let's do the 3M
the
one
mark.
first.
Great trading methodology.
So let me see.
The fact is, it's been a long time. If you can't learn something from me about seasonality, how it's used not only as a beautiful concept, but also as a great trading methodology, then you won't be able to learn it from anyone else, because I've been there and done it many, many thousands of times over. I'm going to start today with what might seem to you to be a little off topic, but you'll see that I'm going to get to my point very quickly. Many people don't know that there is more than one theory of evolution. Most people are familiar with Darwin and his work, and take as gospel the Darwinian theory of evolution, unless, of course, you're a creationist and believe that there was no evolution, that people were just created by a divine entity. There's another form of evolution scientifically called Lamarckian evolution. Most people never heard of it. Jean-Baptiste Lamarck developed a theory, and there are some significant similarities and differences between the two theories, and I'll get to my point very quickly.
Oh, you guys don't know Lamarckian evolution. That's what Google is using to do their AI stuff. Like, so if you were over at Grace's channel, or you were, I think I played that video once again on this channel, the Google blockchain video. I think it was blockchain or the ledger. Yes, the Google ledger. You can look it up on YouTube, the Google ledger. I'll find the link and I'll post it in the chat.
In Darwinian theory, it's survival of the fittest. It's that traits of survivors are passed on to their generations and their offspring, and that over time, the weak ones die off and the strong ones live. Lamarckian evolution is very different. Lamarckian evolution talks about the acquired genetic traits. In other words, why does a camel have wrinkles and calluses on its knees? The Darwinians would say, because those camels who did kneeling for their masters and were weak eventually died off, and only the ones who had calluses and could withstand the pressure remained. And that's how it happened, and of course took many, many thousands of years. Lamarckian evolution is different. It says that if an individual or an entity has, for example, some damage in their life, that damage can be permanent and passed on to their offspring. So, for example, if you took some fruit flies and you colored their eyes blue, it's possible that the next generation of fruit flies would have blue eyes. Only Darwinian evolution survived. Lamarckian evolution did not survive, and there are many examples of Lamarckian evolution. But the reason it didn't survive is there weren't enough examples to support the theory, or there weren't enough experimenters to look for examples to support the theory. And the example that I gave of Lamarckian evolution is just a very weak example. There are many others that are very strong, and you can look them up if you find the theory interesting. I bring this up because trading is similar. In trading, only the fittest survive. Is it possible that other theories of trading did not survive because they weren't researched enough? Well, the bottom line is there are many theories of trading. There's a Darwinian theory, only the fittest survive. Or there's theories like the candlestick theory, or the market profile theory, which I talked about in the past. There's the methodology of the 50 and the 200-day moving average. Over time, Many of these methods that used to be popular have died. The triple moving average theory, point and figure charting, candlesticks. Do you remember the time when there were candlesticks everywhere and people were giving seminars and webinars on candlesticks and saying, it's a harami, it's an engulfing line? We hardly ever hear that these days. What about traditional chart analysis? Head and shoulders, gaps, reversals, key reversals. People rarely talk about them anymore these days because they've been abandoned in favor of other patterns. Over time, patterns will survive or die based on their effectiveness and use in the markets and research. Seasonality is a distinct exception to the rule because it has been around for many years and it continues to survive because traders are proving it correct day after day after day. When I say correct, I don't mean every time. We know that theories are not perfect. Theories are not 100%. But I believe that the closest thing we can find to certainty is seasonality, which is a form of cycles, as you know. And remember that we're talking about seasonals being cyclical patterns that happen within the course of the year, of the calendar year. Now let's talk about something else for just a moment. Gamblers are very keen on statistics. If we considered trading to be a form of gambling, namely that we take risk in the interest of a particular outcome, we take risk in order to achieve a particular outcome, you need to have the facts to support the methodology. Take an example. I have shown you seasonals that have been going on for over 40 or 50 years. What are the statistics there? If we take a sample, 50 years of history, and over those 50 years, 45 of them have been correct. And if you take that statistic, 45 years, 50 years with 45 correct trades, that is a very important number statistically because
My strategy is to buy high, sell low. Yeah. A duro? What's that? What's a duro? Jeez, I don't know anything, man. I'm a boomer, man, at this point. I might as well be. But yeah, so seasonality is a subcomponent of cycles. You can watch this. So, it's a little bit dry, I know, but you got to hear it. You got to hear it because Jake Bernstein, he's an old school trader. Like he's one of those guys that been around forever. This guy and Rick Bensignor. I think I played a Rick Bensignor video like a couple streams ago, and he was talking about Jake Bernstein. He was saying like, well, I don't know if I played that portion of that video, but it was the Rick Bernstein, Rick Bensignor one was when it talked about the options and then again talked about the DeMark indicators. So he was always talking about Jake Bernstein's like, oh, this dude made like 1 billion books, 1 billion trillion books on trading. And so, yeah, he's been around. This guy's been around.
Statistically, it means the probability or the odds of this happening by chance are less than 1 in 10,000, which is very, very important. I want you to think about what you have in seasonals compared to what other people have in the methodologies they're trading. Have we ever seen statistics for point and figure charting? Have we ever seen statistics for the 50 and the 200-day moving average? We haven't seen them because they're not good enough to show. So if you're using a particular methodology and it's frustrating you and you're losing money, ask the obvious question. Does it really work? How does it backtest? Backtesting is a very important issue, but there are ways to backtest. There are ways to rig backtesting. We'll talk about that some other time if there is time. But the bottom line is this. The seasonal methodology has been around for a long time. It's a survivor. You may say that only old traders use it because maybe only old traders remember it. But the bottom line is it gives you everything you need. Specific patterns, as I illustrated in the last several sessions, when to get in, when to get out, and most important of all, the ability to backtest it. Many methodologies that are not algorithmic, or in other words, specifically based on rules, are impossible to test. Therefore, they become a market mythology, not market methodology. Please make sure you understand the difference. So what are we going to do? Let's try and pay some bills. Let's try and make some money. Let's try and put our knowledge to work. And remember, I'm not telling you what to do. I don't have control over your account. I don't know your financial situation. Only you know that. So you have to determine if this particular methodology, if these particular trades that I'm talking about today are right for you. Let's begin like we usually do with the seasonal chart that's showing here. This is a chart of 3M, and as I've told you many times before, we took the high of each year, going all the way back to the starting year and forward to the current year. We made the high of each year 100, we made the low of each year 0. So in other words, we normalized the chart. We removed every year that was different in terms of its trend, and we kept only the pure seasonal trend. So this is an exact seasonal of what the chart looks like in terms of the majority of the years. This is not statistical fudging, it's an actual statistical method. So for example, when the government announces seasonally adjusted employment, they talk about how they took each year and they turned it into a specific pattern, and we're showing only that pattern. So let's put our position ourselves right over here, which is where we are right now. Assuming that this year is the average or typical year, this is what we should see going forward from now until the end of the year. We're going to see how that turns out. But what we want to do is fine-tune it. And let me talk to you a little bit about what I call the look from above. Consider that you're an artist, or you're an art aficionado. You go to the museum and you take a look at the paintings and you see some beautiful impressionist paintings. Standing up close, all you see is dots. As you move farther away, you begin to see the full big picture. I don't want to sit up close and see dots. I want to look at the big picture from outside, like the James Webb telescope, and see the big, big picture. And then, once I find something in the big picture, like this, I want to zoom in and detail it and find the exact location of my buys and sells, which I can do very easily with Seasonal Trader. So what I'd like to do is, as I said before, let's make some money. According to the rules and the methodology that I've been teaching you, right over here, approximately the second or third week of October, we should begin to move up. How do we know that? The line plot is green, which means the trend is up. The plot itself is green, is up, which of course translates into a bull market. In addition to that, we've got some arrows at the bottom, which point to high probability trades in that direction. So during this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, during this approximate 12 weeks, we've got 1, 2, 3, 4, 5 weeks that are highly statistically probability of an up move. This may be good for some people who want the distant view, but I want more. And we do that by achieving a search very simply. So I'm going to go to the search mode. So here's the history of 3M. And this history covers that period of time that we've been looking at. You'll notice there's a trade there that goes from the 27th of October to the 9th, looks like the 8th to me, 8th of November. Not a very long-term trade, but certainly in terms of statistics, it's very impressive. It's had an accuracy of over 80% over the course of many years, 54 years to be specific. So that's one trade we can look at. And it's coming up at the end of this month. We will see how it turns out. If you've been coming back here regularly, you will see immediately what I've been trying to teach you. In fact, you will look at it and you will say, oh my goodness, I cannot believe this is incredible. And what is that I'm referring to? I'm referring to this right over here. Because in this case, specifically Alcoa, it appears that from approximately where we are in mid-November to the end of December, this stock encompasses practically the entire high and low of the year during this period of time. And certainly we want to see if we can make some money with this pattern. Remember, whether you trade this or not, it's an individual decision. But one thing you can do much better with seasonals than with any other method I know, you can go back and look at each year you want to look at and ask the question, is it correct? Is it real? Is it viable? Is it useful? Is it profitable? Has it been? Can we do it? And so, this is very dramatic. Again, as I said before, this is the big view. We're looking down from outer space and we see this thing and we say, unbelievable. What can I do to get in on this move? Well, first of all, we've got until mid-November before we have to make a decision. Second, we can go back to Seasonal Trader and run some numbers. Let me show you what I mean. Let me get back to it. Go to Seasonal Trades, US Stock Trades. Let's find it. Here we go. And I hope you remember the time frame. We're going to go to Alcoa. And before I show it to you, I want to address a very important point. Some of you may be thinking, well, you've done it now, Jake. You've spilled the beans. Everybody knows this trade now. And because everybody knows it, it's not going to work. I want you to think about the idiocy of that statement. If everybody knows it, it will work better. Why? Because if many people get in, it's a very strong indication of demand. The stock will make its move, whether it's justified fundamentally or not, and it will work better. The other side of the coin is this. If you believe that everybody will do this trade according to the rules, then perhaps it might not work. It might be anticipated. But the best thing you can do as a trader is not think about either one of those alternatives. What you want to think about is, does the trade interest you? Is it okay in terms of risk? Do you have the ability to risk on that trade? Can you find an alternative to the stock itself and perhaps just do an option? What is the strategy you're going to use? And what are the statistics about the trade that really show you what's going to happen or what should happen? Because when we look at the chart, we're just seeing the gross chart, as I said, from a distance. We want to dig in close now with a microscope. So we're going to go to Seasonal Trader, and we're going to go to Alcoa. And we're going to go to the right over here. We're going to say, we will risk 99%. What does that mean? If I put nothing in here, it will show me everything without a stop loss. We don't trade without stop losses. So I'm saying to the computer, show me all the trades. Use a stop, hypothetically, of less than 100%, so you can see all the alternatives. And let me cut away for just a moment here. SeasonalTrader.com was the brainchild of myself and Dr. Richard Smith of the Foundation. In fact, he deserves all the credit for having put this beautiful piece of work together. Because even in the last 15 or 20 years, however long it's been, we have rarely had to change anything because it's been working so well. But that's an aside, and that's a story for another day. So let's do this. We're going to go to the month of October. Actually, we're going to go to November because that's when the trade begins. We're going to say for the month of November, I want to see every trade that you have in your historical database and what the results were, hypothetically, back testing. So we're going to go here and we're going to do a search. And lo and behold, here it comes. We've got a trade that begins on the 20th of November, runs through January the 5th, with 83% probability, And here's the history. And you'll observe we can do something here that the vast majority of traders cannot do, or will not do, or don't know how to do because they don't have the history or they don't have the experience. Look at this vast database. It's truly unbelievable. And what happens? These are the results right over here, back tested. A slow and steady growth curve. Yes, there were some losing years, but overall, stellar performance. Now, what could I do with this information? I can go back to the previous step and refine this and say, show me something better. Is there anything better? Let's find out. We're going to go back and do a little more research and say, perhaps we can hold this trade longer. Let's look at trades that are longer than 25 days. Why do I do that? I do that because the big money, as I've told many times, is made in the big move. Let's find the big move, if there is such a beast. Let's do a search. And here we go. And we did find some trades, November 20th through January the 5th. But is it possible that we can do even better? Let me show you. Let's go back to the search, like so. And let's limit the information let's expand the information by looking at October, November, and December. Why do that? Because remember, the big money is made in the big move. And if you think back to the chart, you'll notice that it started in mid-November and went through the end of the month, end of the year. So let's begin actually in October and see if there's anything there. It doesn't cost us anything to do that. Let's remove everything here except for the stop and see what we get. Let's do a search. Well, isn't this interesting? Because by changing the search features a little bit and digging into that database, we've been able to generate the history on a trade that has been correct 90.7% of the time. And let me stop right here and say this. When things are this good, they usually don't last. I'm not saying to you that the same pattern will be repeated this year with 90% accuracy. Certainly there are many other choices. But the mere fact that something has existed with such high accuracy for such a long time is very impressive and speaks strongly to the survival of the fittest in terms of methodologies. Let's take a look. Here's the history. And we're looking at 54 years of history. And we're looking at something very dramatic. Because even after having been available to traders who are looking for seasonal patterns, to see something like this is truly amazing. Now remember, it's very important to understand the history of seasonality as a developing process. In other words, we just didn't find these out of the clear blue. We found them with research, and there are many ways in which you can do research, especially now with AI. You can produce research like this very easily and very quickly, so there's no excuse to not use seasonals. What else do we know about this methodology in this particular trade? Well, we know that the average profitable trade is bigger than the average losing trade, as you can see right over here. We also know that it's had 5 losers in 54 years, and these statistics there are very dramatic in terms of reliability. We also know that it's at a profit-to-loss ratio of 14-1, which means what? If you add up all the winning trades, and you add up all the losing trades, and you divide the sum total of the winning trades by the sum total of the losing trades, the average will be 14-1. In other words, it's made 14 times as much money as it's lost. Now, If this were the only instance of this kind of information, I would be concerned. But it's not. In fact, let's do this. Let's go back on screen to here. And let's return to the search. And let me show you something else. I'm going to clean this up right over here. And by the way, we're going to follow this up. We're going to remember what I said today. And when the time comes, we're going to see how it turned out. Remember, folks, no guarantees. Let's go to October, November, December. And let's go to Deckers. And yes, I picked this one before this session to illustrate as an example. Let me say one more thing. I am not interested in selling you a program or getting you to buy anything. I'm simply showing you a tool that I developed with Dr. Smith, a tool that I use and have been using for many years. There are many seasonal programs out there. There are at least several that I know of. If they don't give you this kind of information, they're probably useless. But this is the kind of information you need, not only for seasonality, but for everything you do as a trader or investor. Let's go to Deckers Outdoors. One moment, please. Here's Deckers. Let's go to the search. And what do we have? We have a 77% trade, not very impressive. But what I want to do is come back to the seasonal chart. I'm going to show you something. Here we go. Seasonal chart. And it should come right up any moment. Here we go. So let's look. This is the period of time that we looked at. But I want to look at something else. How about this 3-week period? How about this 3-week period? Could that be better in terms of performance? Let's check it out. These are the first 3 weeks of February. Let's go back to the search feature. One moment, please. And let's go to return to search. And let's just go to the month of February. So what I'm showing you is a process. And by the way, doing this kind of research is very enjoyable. And if you do a few hours, you'll be able to find some trades for the entire year that will serve you extremely well, assuming you choose the right way and follow some of the rules that I'm giving you. So here we go, February for Deckers. Let's make sure it's still checked. There we go. And let's see what we've got. And remember, we're looking at a very circumscribed period of time. All right. And here's the top trade. And by the way, the computer sorts these trades by putting the highest trade probability at the top of the list. Does this cover the period of time we're interested in? Yes, it does. Approximately the first 4 weeks of February, right over here. And let's look at some other numbers. The average profit per trade, the average loss per trade. Look at this. Percent average profit is 6.71. Percent average loss is 2.9. You can see the average profit is much better. And we sacrificed 3% in performance to get that result. But let's take a look at it. And again, as what I'm showing you is loosely called seasonal research. Here we go. And let's look at the history. Now, isn't that interesting? What does it say? it says that this one loss was so big, it erased a number of years worth of gains. Remember, we have this information now before the fact. That's very important because it basically says steer clear of this particular trade because the possibility of this happening again. That is valuable information to have. It's the kind of information you want to have before you do anything, right? So what are we going to do now? We're going to go back. We're going to look at it again and say, okay, this is nice, but not nice enough. How about this one here? From the middle of May to the beginning of June. No problem. Let's go back. Beginning of May to the middle of June. Come back to me. Here we go. From the middle of May to the beginning of June. So we're going to come back here. And what I'm basically showing you is how to do some research. And we still got Deckers checked off. So let's check the results. Here we go. Okay, again, it's an 83% trade. Percent average profit is much bigger than percent average loss. This is what we want to see. Let's find out if that one scary outlier is still there. Here's the history. And now we're talking. Check it out. This curve is parabolic. Last year was the second best trade ever. We still have a loser here, but remember, if you're an options trader, you can do a lot to mitigate that problem. Very, very simple and very easy to do.
All right, so that gives you a lot of information in that presentation. So that's a little bit of quant trading, right? We're using statistics. We're trying to get some quantifiable data, add in to cycle data. So this is where the edge comes in, you know. It's very dry, very boring. But if you want to have something that's going to give you an edge over the house, because trading is just gambling. That's basically what else can I say? You know, and investing is also still gambling. It's just on a longer time frame. And this is why you're going to have to do whatever it takes for you to have an edge on the house. Otherwise, there's no point in doing any of this. Otherwise, it's just better for you to buy the S&P 500 on a dip, ride it to the high, sell again, because if you don't have an edge over that, forget it. It's just a wasted effort, honestly. So that's why most people will tell you, like, oh, you have to do the 40-60 portfolio, 60% like stocks, 40% bonds, and then when times go bad, 60% bonds, 40% stock, this and that. Very dumb, very no-brainer type stuff. But if you want to make the real money, you got to have that edge. And that's one way of doing it. So let's exactly look at some of the stocks that he mentioned. I talked about aluminum. I talked about Alcoa. That's one of them. Here's Decker. This is the one he was looking at. Right? If he did the February trade, it wouldn't have worked out because he would have bought here, got off here, not much. Really not much of a gain. If you did the, I think early May here, right here, May to June, perfect. That would have been a good trade this year. Now let's look at Alcoa. Alcoa already had a bump. We already seen this chart where it's made its bottom here, kind of around the same area that it made a huge drop during the financial crisis, bounced up. So this area is sort of a midpoint between here and the actual bottom here before the COVID panic lows. And now we're back up here. So if we're assuming that November to January of next year is going to be good, then I guess we'll have a breakout pretty soon in aluminum. And there's a lot of aluminum stocks also looking quite well. So we talked about that last week. And then the other one was 3M. I mentioned that it had earnings, had a dip, 7.69% last week. Now we're recovering a bit on an upgrade. So if it has a similar pattern, it's going to hold this support here and then try to make a new move up into January. Perhaps that's true. Perhaps that trade is true. So there you go. That's 3 stocks to look at using those seasonal patterns that he was discussing. So that's one way of looking at things. So you looked at the cycles, you got the seasonals. Now we're going to go back to Wyckoff. And I don't know if I can do it too much today. I wanted to do some scanning today, some video on scanning. So we continue on the discussions that we had on Friday. Yeah, I don't know if I have time. Let's see. Let's see how far we go. Let's go to the basics.
Mid-August.
Okay, let's skip through.
And
skip
so
through. Here we are.
And today, you just want to be Adventures Through 40 Years, published in 1930, shortly before his passing.
So this is Wyckoff's book, A Wall Street Ventures and Adventures. So, I mean, if you just did the homework, you don't need to do that. Okay.
Out of print, Wall Street Ventures and Adventures Through 40 Years, published in 1930, shortly before his passing. And today, what we're going to do is we're going to listen to his words about his experiences from being a young man in 1909, which he was in his early 20s. And we're going to understand what the motives of the composite operator are using a mystery stock. This mystery stock is from a full 100 years later than this first lesson that he learned, which we're going to read about now. And so we are going to use this lesson from 100 years later, which tells us that there's nothing new under the sun in the way that the markets function. Yes, some of the rules change, but the basic principles of best practices of accumulation and campaigning and distribution are all the same and true today as they were back at the turn of the 20th century. So let's hear Mr. Wyckoff's words and then apply them to this mystery case study that we have. This is about E.H. Harriman, who was a great market speculator, a composite operator from the turn of the 20th century. He used Union Pacific Railroad as his chief tool for doing these composite operations, but he also had a very notable partner in his pool operations, and that was Rockefeller. So very, very important, very big operators of their era, and they were working together. So the manipulation of leading stocks, writes Richard D. Wyckoff, chiefly of Union Pacific, their market leader bore the Harriman imprint and was clearly defined and easy to interpret if one understood manipulation at all. In other words, easy to see on the charts if you know what you're looking for. That's what Richard D. Wyckoff, called tape reading. All one had to do was to be able to detect evidence of accumulation when a bullish operation was being prepared. Accumulation is the preparation of a bullish operation. When the stock reached what I call the jumping off place and was ready for its upward swing, then was the time not only to go with it, but to pyramid. And that is really a cornerstone of the entire philosophy of Richard D. Wyckoff, was to let the CO build the bullish accumulation campaign and then jump on board when it's ready to turn into an important new fresh uptrend. That is so much a cornerstone of the Richard D. Wyckoff methodology. Harriman's method in such a campaign was first to poke a stock down to as low a level as he thought advisable, the blue arrow, then gather in everything he could find within a certain buying zone. There would be drives for the purpose of shaking out weak holders who had placed stops or who could be scared off by signs of weakness. So the composite operator is always trying to build their position in the bottom half of an accumulation area and average cost roughly the midpoint of the accumulation area for their entire holdings. And so you can see here the signs of the shaking out that took place, where the bearish drives to and through the selling climax low, which occurred in this case 3 additional times. After this, Harriman would keep his stock dead within a range of a few points for weeks at a time, so that nobody could make any money trading in it, and those who held it would be discouraged, throw it out, and get into more active issues. This is what I referred to here as the dead zone. Look at the volatility coming out of this chart.
Playing from Win 10 Bronze.
It's being squeezed out into what is occurring, which is absorption. It's accumulation of shares from weak hands to strong hands. In other words, he first shook them out, then he tired them out. And there are the labels for this accumulation structure. Again, 100 years later than the lesson that Mr. Wyckoff is teaching us here. One, knowing how to interpret these movements, which were there for everybody to read, but were understood by few, would observe that thus that the transactions tapered off to almost nothing just before a real move began. That was because there was no more stock for sale at that level. It had all been absorbed by strong hands. No use in putting it further down now. Everybody was shaken out, and a new weakness might bring in fresh and unwelcome buyers. No advantage either in putting it up until the last 500 shares have been gathered in. These were the lessons that Richard D. Wyckoff learned as a young man, because he really wanted to understand what drove the large interests to build a position in a stock and how he could see it on the charts. And so now everybody was shaken out. That's the moment at which the pivot up into a new uptrend can occur. So, and here again, this is a case study. Our mystery stock is from 100 years later. What is our mystery stock? Well, let's have a look. Oh my gosh, it's Apple from 2008, 2009. This is a stock at that time that we evaluated in the classroom. We looked at it every week through the spring semester of 2009. And I was also at that time building a position for a campaign personally to follow the composite operator up with this stock into a new uptrend, which we all talked about in the classroom. And I want to make a very special point here that at the moment of the spring low here in January of 2009 was also the moment at which the uptrend in the relative strength began. This was a tool that Mr. Wyckoff used, had to do in a more fundamental way, comparative analysis that we can do with relative strength. But look at how, even though the accumulation wasn't complete yet, that Apple all of a sudden was going into its own important uptrend of relative strength, which shows renewed leadership. So, and you can see here the rising trend, which followed the price of Apple upward. What did Apple do after this point in time? You can see here that Apple built that base in the yellow shaded box area. The relative strength is in a long-term uptrend. And look at that run from 2009 into 2012. And of course, we know that Apple went on to go much higher after that. So John, that's my lesson for today on the words of and wisdom of the master, Richard D. Wyckoff.
Fantastic. We're going to use some of that thinking to create a very simple scan that anyone can try on their own. Looking forward to that.
Fantastic. Well, let's get to it. I will only add here that you can see an analysis of this accumulation area in a 2015 blog post that I wrote, Wyckoff Power Charting, Let's Review. Go to the archives. You can see this chart all marked up with the phase analysis, which is very, very important. Also in that same article is the accumulation schematics. And I would take those words industry groups, best stocks in best groups. And with that, Johnny Scan has created a scan for us today, which is really powerful. John, take it away. Show us what you got.
Thank you, Professor. Let's take a look at searching through industry groups, and let's keep in mind some of the words of the master and basically a concept that he's expressing both explicitly and implicitly. When absorption has occurred, when large interests have accumulated their positions, price exists often at a higher level. They've absorbed, people see that, the other chart readers out there, and we have acceptance of price at a higher level. So if we use that basic concept and craft a scan in our industry group area, what do we get? So here, we're going to make this list public. This list will be the 104 industry groups that I follow and have in a favorites list. But let's simply rank those. Let's not exclude any of them. Let's just rank them by the difference between the current close and a 63 period, which is a quarter of trading, the high over 63 periods. So the highest high over 63 periods versus the close. Let's take a look at what that does for us. We have 104 candidates. That's the number of odds.
There are only 3 paragraphs. Also in that, even though the accumulation wasn't complete yet,
So this part here is a relative strength moving up. Okay. This is where we're at. So this part is what I've been scanning for. Now up here, they're scanning for industry, and it's pretty simplistic. It's pretty simplistic. So I think I did a more sophisticated scan with that. Right here. Yeah. So this is really simplistic.
So
right
here, a bar,
right. And
property casualty.
I'm gonna move on
a
to
small
another.
structure here, part of a larger higher level. They've
Yeah,
absorbed.
I did a
People
more
see
sophisticated one than they did. So I'm going to go move on to a next video here. We're gonna do average true range. So this one.
volume over 10 periods, and that needs concept of range
Yeah,
true
I
range
covered
and
this already
average
for
it
you
over
guys.
time for ATR. Going to combine that with a volume measure and relative strength. So that takes us to our scanning workbench slide, and here we have groups: Dow 30, S&P 500, NASDAQ, MDX, S&P 400. So we have approximately 1,000 candidates that we're polling. We're looking for an ATR over 3 periods that's significantly less than its 20-period counterpart, 0.75. We're adding a mathematical function to take 3/4 of the ATR 20, and we're less than that. We're also going to look at the SMA of volume over 10 periods, and that needs to be less than 75% of its bigger brother, SMA 20, on the volume. Going to look at percent relative over a calendar quarter, 63 periods, and we want the relative strength to be up, percent relative there. Optional language you can take a look at is rate of change 5 period. Would we want to have that in? Do we need that? All questions you can consider, and simply take out the slash marks, and you get to try that within your own scanning effort. So we're going to echo a scan term here, the percent relative. That's going to be our ranking. So we're going to rank by percent relative. The strongest first will be the profile that we're going to get. If we look at our results page, we have only 19 matching results out of almost 1,000 stocks, potential stock candidates, only 19. We do see that our percent relative on the first level is 48.391 and down to the bottom 0.203. So we did get the sort that we asked for. Let's take a look at our first chart. We're going to look at Nordstrom. Downtrend, downtrend, downtrend. Look at all these red arrows that show where price moved up to the demand line, took a hard fall 4 times, finally to an underthrow, horizontal structure, back out, lower volume, less volatile. Very important features for the Wyckoff world. What do you say, Professor?
Well, this is really an interesting chart, because these jamming up into the top of the channel is all occurring in the context of a negative relative strength. And so this is basically an attempt to gin up interest in the stock by institutions that want, or large interests, let's say, that want to sell the stock on a scale down. And so you can see this is in their playbook. Just jam it up, and then sell it, jam it up, sell it, jam it up. And now you have the completion, or at least for the moment, of a downtrend with this throw under range-bound condition. So it's now acting differently than it did throughout any of these prior periods, where the relative strength is showing a new characteristic where it's above its moving average, it's living above there, and it's moving up into the downtrending trend channel. And so this is really an important place, because the 200-day moving average is where it's resting right now. And if it can get above that and get above the downtrend, that will be a very constructive action. And then also this is coming with the relative strength trying to turn up, and with very low ATR. And so the ATR could very well start to jump as it's jumping through here, if it can. So really a great case study. And now this looks like a completed cause for some kind of a base structure, point and figure, at least a swing trading count for higher prices potentially. And so especially with this jump up and out, Look at the characteristic change here. This jump here occurs with a very shallow backup where all the prior jumps resulted in important selling. So this is a positive, constructive event. John?
Absolutely. And look at how we did achieve our scan requests. Here we have lower volatility, rising relative strength, and it's hard to see, but the volume has contracted too. So the number of transactions, the range of those transactions, all different. And it signals a change of character, which is why Wyckofians, we really expect something breaks out, holds higher level on decreasing volume. We expect that that is going to be productive for future price action.
And also, I'd like to make the point as we go here and through the rest of these stocks, is that when you complete some kind of a minor or major accumulation, volatility by nature in a Wyckoff accumulation structure is going to have diminished volatility. And you can see that occurring throughout in this example here. And so lower and lower and lower throughout as it's starting to work its way into an uptrend.
Absolutely. Our next slide is very interesting also. This
Yeah, so I mean that Nordstrom stock didn't do so well. I mean, honestly, yeah. I mean, it tried a couple times into 2022, but it never really got out of that downtrend. So that is the problem. Like you can see signs, but they're not guarantees, right? So that's why everything to get an edge is going to require a lot more work, I think. And yeah, we're going to have to discuss more about how to scan for these things into the next several programs. So I got to go. Quite busy right now. It's almost 2 p.m. my time. I'll see you guys later tonight. Hopefully we'll see something. I'll try to complete some because I have a lot more videos about scanning and we're going to have to go through them. Yeah, we're going to have to go through them. I have to figure out which ones are more important because I'm going to start employing more and more scans and we're going to try to find some ways to look and detect things in a more efficient way because we'll need it in the coming weeks. Definitely. And I think the next 2 weeks after elections is going to be crazy because we haven't crashed all October. And guess what? That means we're going to keep going up this week. This week we should be going up. And I expect bad things to happen after Friday. If we make it through Friday, we're making a new high. Perfect time to hedge or sell. I'm going to be looking at my Palantir. Maybe my Palantir will be at 50. Maybe your NVIDIA will be making a new high. Try to trick people. Get that NVIDIA up. Get that NVIDIA up. Get that NASDAQ up. We're going to be doing quite well. NASDAQ will make a new high. Yes. Maybe. And we'll go on from there because I see if the tech is going sideways, then let me show the oil stuff again. Yeah, you see this oil? Yeah, oil XOP. Oil stocks. We've been in a range since June 2022. We made a huge correction to July 2022. We've been holding this pattern since that time. So that's 2 years. Over 2 years now. We're going to go into 3 years. And I think the third year, so we're going to probably try to climb back into spring. And then summer, we'll be making the great escape. The great escape into 161. So I'll see you guys then. Okay. And I forgot to put up the banner. Yes, the banner. You're gonna have to go and donate to the Halloween costume contest. I think we're at $900. Yeah, we're at $900. So that's pretty good. Pretty good. We're gonna have from October 31st, 9 p.m. CST and 10 p.m. EST. I think I got to change that to EDT. We're still on daylight savings time. Only Europe has switched off of daylight savings time right now. We're still on daylight savings time. So Europe, you take that into account. Okay, if you're in Europe and you're watching this, take into account that we have not switched to standard time yet. We're still on daylight savings time. Okay, and let me get the banner up. The banner right here. Man, it's so slow. StreamYard's really is getting. I got my StreamYards or something. You see the whole thing. Urban Landlord, Haunted Hotties. Yeah. Okay. Yeah. There we go. Yeah, and October 31st, 9 p.m. to 10 p.m. Eastern. So 9 p.m. Central, 10 p.m. Eastern. Enter your chance to win. We have now about $900. Here we go. And that's about it. I'll see you guys later today. StreamYards really is acting a fool today. Really acting a fool. I have no clue. All right. I'll see ya.